12 out of 16 economists polled by Reuters expected the Monetary Authority of Singapore to hold policy steady this week. Instead, MATS tightened for the second consecutive review. When consensus gets a central bank decision this wrong, retail investors tend to look at the wrong headline. If you hold geared REITs in your CPF or cash portfolio, this decision reaches your quarterly distributions faster than you think. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. When 12 out of 16 institutional economists predict a pause and MATS delivers a tightening step instead, it tells you that street consensus is playing catch-up to domestic price pressures. This isn't just a missed forecast by macroeconomic analysts. It is a structural signal that domestic liquidity conditions are being actively steered by the central bank. When institutional consensus is this wildly wrong, the headline deserves a proper forensic pass rather than a cursory glance at broker notes. Long retail commentary focuses entirely on headline CPI and price levels at the supermarket, but that is not where a central bank tightening decision hits your investment portfolio. The real impact lands directly in the funding cost line of every geared real estate investment trust listed on the Singapore Exchange. The transmission path doesn't stop at the macro level. It flows straight down into interest cover ratios and distribution per unit line items. Let's trace how this mechanism moves through a name already on our ledger. Let's look at what MATS actually executed in this review. They raised the rate of appreciation of the Singapore dollar nominal effective exchange rate policy band. This is the second consecutive tightening step, following the April steepening that reacted to the Strait of Hormuz conflict and crude oil price spikes. Crucially, only the slope of the band was adjusted upwards, with the magnitude being smaller than April's move. The width and the center of the band were left entirely unchanged. The justification from MATS centers on elevated core inflation metrics driven by transport costs, non-cooked food prices, the recent tobacco tax hike, and persistent import cost pressures. Central bank projections show core inflation climbing steadily into early 2027 before easing in the second half of that year. When core inflation remains sticky above comfortable baselines, monetary policy has to lean against price expectations before higher costs become permanently entrenched across the local economy. This tightening step was made possible because domestic growth figures came in strong, with second quarter gross domestic product expanding by 5.7% year-on-year, well ahead of consensus estimates. Growth is being powered by artificial intelligence capital expenditure, a full construction project pipeline, and steady credit expansion. MATS' logic is straightforward. Use the strength of the Singapore dollar to lean against imported inflation now, because the underlying economy is strong enough to absorb the tighter financial conditions. A central bank tightening decision does not mean all S-REITs suddenly suffer severe financial distress. Skipping the actual transmission mechanism is precisely how forensic discipline dissolves into panic and headline overreaction. We do not operate on emotion or sweeping market narratives. We follow the precise balance sheet transmission mechanism from central bank policy down to individual trust balance sheets. Unlike the Federal Reserve, MATS manages monetary policy through the exchange rate band rather than a direct benchmark interest rate. When MATS steepens the policy band slope, domestic liquidity conditions tighten over time, which can cause the Singapore overnight rate average to firm up. However, SORA is heavily influenced by domestic money market liquidity and global US dollar interest rates, rather than acting as a direct mechanical lever of the exchange rate slope. We must treat this correlation with analytical rigor rather than assuming an instant step up in borrowing rates. Looking at where benchmark rates sit today, 1-month SORA was at 1.01% as of mid-June, remaining comfortably accommodative compared to the elevated levels seen throughout 2023 and 2024. 3-month and 6-month SORA readings stood at 1.08%. However, there is a clear data gap here. These published readings predated this week's MS decision, meaning we must run fresh data pulls post-decision, rather than assuming these historical figures remain static in a tightening regime. The structural risk exposed by this policy move lands squarely on specific balance sheet profiles. Any REIT carrying meaningful floating rate debt exposure or facing debt maturities that require refinancing into a less accommodative rate environment now carries an elevated version of a risk factor already monitored on our checklist. A trust sitting right near our 35% gearing ceiling or our 4 times interest coverage ratio floor has significantly less financial room to absorb a funding cost surprise. Let's run a live test case using Keppel DC REIT from our ledger. Aggregate leverage sits at 34.0% as of 30 June 2026, clearing our 35% gearing ceiling, though the safety margin is narrow. Trailing interest coverage ratio is comfortably above our 4x floor, though the exact reading needs a fresh pull before this publishes. On top of that, 37.8% of its total debt is denominated in Japanese yen, which represents a separate live variable. There is a tempting surface narrative floating around retail forums. A stronger Singapore dollar means a lighter Japanese yen debt burden when converted back into SGD terms, which sounds like an automatic win. But the reality is far more complex. The mass exchange rate policy band is measured against a trade-weighted basket of currencies, not against the yen specifically. There is no clean source data showing how this specific slope adjustment moves SGD against JPY. We flag this data gap directly rather than manufacturing false comfort. Here is the core forensic truth for Keppel DC REIT. Its current Zone 4 status is completely unaffected by this week's MES decision. The live hard gate failure on this trust is operational occupancy, not funding cost or leverage limits. The Cardiff data center in the United Kingdom remains at effectively zero occupancy, pulling portfolio-wide occupancy down to 92.5% against our strict 95% forensic floor. The balance sheet is not what failed this name. Our forensic verdict on Keppel DC REIT is Zone 4 caution. It maintains a fortress balance sheet and clears the yield hurdle comfortably on both trailing and forward basis, with the Cardiff data center vacancy as the sole constraint keeping it out of primary investment zones. Sitting in Zone 4 on this single identifiable gate failure is a timing question tied to asset retenanting, not a structural or permanent rejection of the trust. How you interpret a Zone 4 rating depends entirely on your investment horizon and capital needs. A long runway investor with capital beyond immediate income requirements may view this timing constraint with patience while waiting for retenanting progress. Conversely, an investor who is drawing down capital or relying on immediate distributions this year must weight that single gate failure far more heavily. Both interpretations sit comfortably within how our framework is calibrated, and this remains an objective balance sheet classification rather than a directional call for either group. A 34% aggregate leverage ratio is not failing any hard gate today. However, possessing only 100 basis points of headroom to our 35% ceiling represents the entire margin for error if refinancing costs shift before the next earnings cycle. In a central bank tightening bias, the names you must watch closest on the exchange are not necessarily those with the absolute worst headline metrics, but those operating with the least balance sheet headroom remaining. Looking beyond Keppel DC REIT across the exchange, Parkway Life REIT stands out as a key watch item. Its aggregate leverage has been creeping toward our 35% ceiling as of the last confirmed balance sheet data, and it was already flagged for a strict gate retest at its imminent financial results. A firmer funding cost environment, even if mild, adds material pressure to why that balance sheet retest matters for a name trending so close to an analytical threshold. The broader takeaway for all SGX REIT holders is very clear. Our 35% gearing ceiling and 4x interest coverage ratio floor are not arbitrary numbers drawn out of thin air. They exist precisely because macro funding conditions shift over time, occasionally on a Monday morning central bank surprise that most market participants failed to anticipate. Maintaining strict balance sheet headroom buffers is what protects income capital across changing monetary cycles. The forensic verdict on a stock doesn't change just because management has a compelling story or because a quarterly bill needs paying. Most financial channels on YouTube depend on corporate sponsors, affiliate referral links, or inflating subscriber metrics to generate advertising revenue. This channel operates as a passion project with zero commercial ties or sponsored content. That absolute independence is the actual reason a Zone 4 verdict stays a Zone 4 verdict until the underlying data genuinely changes. For retail investors who want to stay ahead of these macro shifts, Iggy's Elite Investors provides zero-day forensic breakdowns the moment filings drop, completely free of commercial bias. Members get full access to our complete red zone watchlist to spot trusts running close to leverage and coverage gates long before headlines hit the press, alongside institutional-grade balance sheet cheat sheets built without a single sponsor's name attached. At 12 Singapore dollars per month, joining the paid tier costs less than 2 kopi and kaya toast sets at Raffles Place. You are not just getting the forensic reports and watchlist updates before the general public. You are actively funding independent data-driven SGX analysis and ensuring these balance sheet breakdowns remain honest, uncompromised, and accessible. Looking at our core benchmark anchors, MRs held its full year 2026 core inflation forecast range at 1.5 to 2.5%, showing that underlying baseline expectations remain anchored. Meanwhile, the CPF special account rate stands unchanged at 4.0%, representing the highest quality guaranteed SGD yield available in the system. A central bank willing to tighten policy preemptively provides a vote of confidence in currency stability and CPF real returns, which reinforces why our 4.7% forensic yield hurdle still means something. It is critical to distinguish between a short-term surprise and a structural regime change. Today's central bank decision is a single tightening event within an established policy band, not a signal of structurally higher SGD borrowing rates forever. No ledger zone assignments are being altered today. What this decision does is dramatically raise the value of knowing which trusts possess real balance sheet headroom and which are operating near the edge. That distinction was true last week. It is simply more urgent today. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access. Link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MES licensed financial advisor before committing funds.